The data is clear. Stocks that have insider purchases tend to outperform the market over different periods of time. And just like the great Peter Lynch once stated, insiders might sell their shares for any number of reasons, but they will buy them for only one: they think the price will rise. So in this video, we're going to be looking at 4 different dividend stocks that you can actually buy cheaper than the price that insiders recently purchased them at. So let's go ahead and dig in. Our first stock that you can buy cheaper than insiders is going to be HF Sinclair Corporation, and the stock ticker is DINO. And this is a company who has seen significant share price reduction over the past year. But we can see insiders started purchasing this stock this year at about $55 per share and have bought a few more times on the way down. And if we look at the share price over the past year, it's down about 24.61%, currently trading at about $39.19 per share, significantly lower than when insiders started purchasing it. Now, if you haven't heard of this company before, it's an energy company focused on oil and gas, and it's based out of Dallas, Texas. And if we jump over to my dividend breakdown sheet and come up here and plug in DINO, all this data will automatically load in. And like always, if you'd like to be able to automatically import stock financials straight into your spreadsheet via the ticker data add-on and also get all of my spreadsheets, then you can head over to tickerdata.com at the link in the description. Now, what we can see about DINO, the starting dividend yield is very high, sitting at 5.11%. But look at the dividend history here. What's going on? It looks like we see quite some fluctuation in the dividend payments. Well, 2013 to 2014, if you dig into it a little bit, they actually paid out quite a bit in special dividends, bumping up the amount they paid out in dividends. And then after that, the dividend was relatively stable. And then in 2021, the dividend payout was quite a bit lower than it had been over the past decade, but since then, it has recovered and is above where it was pre-2020. Now, why is there fluctuation in the dividend payments for a company like this? Well, you have to understand very often energy companies are going to be very, very cyclical. For example, if we jump over to the stock screener, let's come up here and plug in DINO again. Here's what we can see. If we look at earnings per share, again, very cyclical. There's a lot of fluctuation. It's very hard to predict what the future free cash flows for the company will be. Same is true with revenue per share. There's a clear upward trend, but it goes up and down quite a bit, and the same is true with free cash flow per share. Another example of this is if we jump over to my profitability sheet, look at the gross profit ratio for this company. The 10-year average is about 15.48, but there's been a lot of fluctuation with those profit ratios. So yes, it is a very attractive starting dividend yield, looking at it at about 5.11%, but we do also have to take into account the stability of those payouts in light of earnings fluctuations. Now, with that being said, this is a company that's very focused on returning capital to shareholders. For example, earlier this year, this company announced a 1 billion share repurchase program and a regular quarterly dividend of 50 cents per share. So we already touched on the dividend. Let's talk about this stock buyback, 1 billion share repurchase program. That is a massive share repurchase program for this company because keep in mind, look at the market cap for this company. It's only sitting at about 7.39 billion. So this company is buying back a lot of their own stock. And if we jump back over to our stock screener, jump over here, we can see they had been buying back shares from 2013 down to about 2020. Then they had to raise some new capital, it looks like, but again, they're focused on buying back stock once again. So this would be a company with a very high shareholder yield, which again is going to be the dividend yield plus the buyback yield. If we look at some free cash flow valuation metrics, the company does look like it's trading at a great value compared to its 10-year averages, but the problem is the fluctuation of those future payouts. Yes, based on trailing 12 months, the company definitely looks undervalued, but there's no guarantee that they can maintain the level of free cash flow they've generated in the last 12 months. But with that being said, it should give you confidence that insiders have been purchasing this stock on the way down. The next stock insiders have been purchasing that you can buy cheaper than them is Occidental Petroleum Corporation, stock ticker OXY. We can see, looks like back in summer of this year, there's pretty significant insider purchases, and even earlier this year, the same is true. But here's what's even more interesting about this stock. Look at Warren Buffett's purchases over the past 3 years. He's been adding quite a bit to his portfolio, and even if we look at the past year, he added a significant amount of purchases, again, around the summertime. But what's even more interesting is his average buy price is estimated to be about $54.50. But look at what the stock is trading at right now, $48.41. So you have an opportunity to buy the stock cheaper than Warren Buffett did. Now, that doesn't necessarily mean you should go and add it to your portfolio. Anybody can be wrong about an investment, and everybody has different goals and investment time horizons, so keep that in mind. But if we look at the past year, the stock is down about 15.12%. Let's look at it from a dividend perspective. We'll come up here and plug in OXY. And here's what we can see. The starting dividend yield as of right now is sitting at about 1.82%. And when we look at these dividend payouts, again, there's a lot of fluctuation. Why is this? Well, again, we're looking at an oil/energy company. They're going to be very, very cyclical. So again, if we jump over to our stock screener, let's go ahead and plug in OXY once again. If we come over here and look at earnings, again, there's going to be a lot of fluctuation. Now, the past 3 years, we have seen positive earnings, so that's a good sign, and the same is true with free cash flow per share. But for example, just to show you how cyclical these companies can be, if we jump over to my free cash flow sheet, pay attention to the free cash flow margin. This is telling us out of how much revenue the company is generating, how much is actually becoming free cash flow. So for example, if a company generated $100 in revenue and free cash flow margin was about 21.46, then $21.46 would become free cash flow out of that $100 of revenue. But if we look at the free cash flow margin for this company over the past decade, it actually fluctuates quite a bit. Now, it's quite a bit better than a lot of other oil stocks like DINO, the one we just looked at. But again, there's a lot of fluctuation here. But the good news is we can see the past 3 years have actually been the best 3 years when it comes to free cash flow margin for this company, which is a good sign. Now, when we touch on this dividend again, we can see they sliced the dividend pretty heavily in 2020 and it has not since recovered. So how sustainable is that dividend payment? Well, one of the things we have to remember is these oil companies, these energy companies have to use a lot of free cash flow on capital expenditures. They're very capital intensive businesses. But if we jump back over to the free cash flow sheet, we can see our dividend paid and CapEx coverage ratio. This is combining the dividend payout ratio along with the capital expenditure ratio. And we can see when you combine them, as of right now, based on the trailing 12 months, it's sitting at about 1.4. Their cash flows can cover their dividends and their capital expenditures, and the good news is, if we look at the forward-looking statement recently made in their earnings report, we can see right here, the company is targeting production growth in the mid-single digits. That's a good sign, but we can also see capital spending largely in line with this year's levels. So there shouldn't be a big jump up in capital expenditures. So again, keep in mind with these energy companies, they're very cyclical. But I think this is an interesting play when you look at all the insider purchases over the past year and how much Warren Buffett has been adding to his portfolio really over the past 5 years. Our next stock that you can buy cheaper than insiders is going to be Prospect Capital Corporation, stock ticker PSEC. And we can see there's been pretty significant insider purchases over the past year. They all kind of came around the same time period. And if we jump over to Seeking Alpha, we can see the stock is only trading at $4.40 per share. And over the past year, the company's down around 24%. Now, if we jump over to my dividend breakdown for this company, let's go ahead and plug in PSEC. Here's what we can see about this company. It has a massive starting dividend yield of 12.3%. And believe it or not, when I first started dividend investing over a decade ago, this was actually a company that I added to my portfolio. And it was a major mistake that a lot of dividend investors make when they first started out. I was clearly chasing dividend yield. Look at how the company's traded over the past 10 years. It's down around 49%. And in fact, when I added it to my portfolio over a decade ago, the company was actually trading close to around $10 per share. Now, with that being said, insiders have been heavily purchasing the stock this year, so have things changed? Well, recently there was a major change to the business. Actually, we can see the company just announced a 25% dividend cut. So what does this mean and how will it affect the business? Well, the company announced a 25% dividend cut as it rotates structured credit collateralized loan obligation, equity, and real estate investments into its core business of first lien senior secured middle market loans. Okay, so that's a mouthful. What does that even mean? Well, first off, let's start with the company's core business, senior secured middle market loans. What does that mean? Well, basically the core business for PSEC is giving out loans to middle market companies, so that's basically smaller to mid-sized businesses. And what PSEC is saying is they're rotating structured credit collateralized loan obligation, equity, and real estate investments back into its core business. So it's taking these high yield debt instruments and rolling them back over into their core business. So really what's going on here is a strategic business shift for PSEC. They're going back to focusing on their safer core investments, which did make them decide to cut the dividend by about 25%, but I actually do think this will provide more stability with their dividend payment moving forward. Now, obviously, anybody who was previously buying this stock was buying it for the starting dividend yield, so there's definitely no surprise that we've seen a sell-off in this stock. So again, I think the end goal here is to make those dividend payments more sustainable for shareholders. And then our last stock has seen more insider purchases over the past year than any other stock that I really know of. And these aren't just insider purchases, they're purchases mainly being made by the founder himself, Bernard Arnault. He's buying his own company, Louis Vuitton. Look at this, if we scroll down, we can see he's made significant purchases in the past month alone. We can see a purchase right here just a few weeks ago, December 5th. Tons of purchases in the month of November. Now, here's what's probably most interesting about this. At the end of 2023, the Arnault family group owned about 48.6% of Louis Vuitton shares. So now they likely own over 50%. Why is that a big deal? Yes, of course we can talk about voting rights, But here's what's really interesting about founder-led companies. If we scroll down, I was talking about this on Twitter just the other day. What research tells us is that founder-led companies have typically outperformed the market over time. And that's certainly the case for Louis Vuitton. Now, if we jump over and look at the share price over the past year, this company is actually down about 13.24%. In a year when the S&P 500 is up around 30%. So the company is currently trading at about $668.45 per share. Now, if we zoom out, we can see the all-time high for this company was pretty much right at about $1,000. So it's down pretty significantly from its all-time high in summer of 2023. And this is likely due to a few different reasons, but mainly just weakness in the economy and especially over in China. For example, if we jump over to my profitability spreadsheet, let's come up here and plug in LVMHF. What we can see is earnings growth for this company over the past decade has been really good, and the same is true with revenue. But what we've been told is revenue is going to be a little bit stagnant for around the next year, and obviously the market does not like the sound of that. Now, something else impressive about this company is look at the gross profit ratio. This is a company that sells luxury goods, and the gross profit ratio clearly shows this. 10-year average gross profit ratio is sitting at about 66.2, and last year's was 68.8, so we're talking about very high margins. And if you look at all the companies that are within Louis Vuitton's universe, you'll realize why the margins are so high. As the company has grown over the decades, they've been very focused on acquiring other luxury companies, and many of these you've probably likely heard of. Now, if we look at this company from a dividend perspective, let's go ahead and plug in LVMHF. Here's what we can see. The starting dividend yield for this company is a little bit above 2% right now, and the dividend growth over the past 5 and 10 years has been really good. We're talking about 15% and 14% dividend growth. So look at this over the past decade. We've gone from about $3 per share to in 2023, $13.72 per share. So really solid dividend growth, and the free cash flow payout ratio for the most part has remained in a pretty healthy range. It's been below 60% for the entirety of the past decade. Now, it's climbed to the higher side of this because free cash flow has dropped a little bit over the past few years, while obviously the dividend payments have increased pretty significantly. Now, one of the things we also have to understand about Louis Vuitton is this is a European company, and typically European companies do dividend payments a little bit differently. For example, most American companies are going to pay on a quarterly basis, but Louis Vuitton actually pays on a semi-annual basis. So for example, if we scroll down and just look at these dividend payments, you can typically see they're going to have one large dividend payment every year and then a smaller dividend payment every year. So 2 dividend payments, and they're going to be different sizes. Also, make sure if you invest in international companies that you understand the tax consequences. Now, Louis Vuitton is actually a stock that I added to my portfolio for the first time this year. If we jump over to my do-it-yourself investor toolkit and blow up my growth chart, you can see right here, this is my Louis Vuitton position. I'm currently down about 4.59% on this position, and you better believe it gives me a lot of confidence seeing all the insider purchases over the past year in this company. There's definitely some economic headwinds this company is having to face right now, but I still feel pretty good about them for the long term. So there you go, those are 4 stocks that you can currently purchase cheaper than insiders. If you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.